Let's now turn to the advisory, and joining us, Rob Gilmour from Wealth Simplicity, to take a look at what is expected from tomorrow night's budget, particularly in terms of tax changes. Rob, welcome. There's been so much speculation, hasn't there? Particularly for investors in terms of the tax treatment on investments. Let's start with capital gains tax. Given those concessions that are there now, what are we expecting and what would the implications be?
Yeah, well, what's been gradually leaked over the course of the last couple of weeks and even more recently pre-budget night is a move to the old indexation method of calculating capital gains tax and removing the 50% discount. So there is supposedly a transitional period, so that's not supposed to come in until the 1st of July 2027, so you don't need to rush out there and try and buy properties. But what will essentially happen is your previous 50% discount will be in place up until 1st of July next year, and then it will transition to that index-based method of calculating capital gains tax on every asset, with the exception of newly built properties, we hear.
All right, I mean, there's very much a focus on property. What about super, and in particular SMS, how they're likely to be affected?
Yeah, well, actually, this actually does make superannuation look quite attractive, because there's no word that any changes to the 33% discount will apply inside super, and it would be incredibly complex to put that onto the superannuation system in such short notice. So if you're still getting a 1/3 discount on a residential property inside super, that's effectively a 10% CGT rate on residential property in super, and in pension phase that's actually 0%. Comparatively, superannuation is still looking pretty good for property investment.
Let's turn to negative gearing, the tax break for property investors. Once again, what do we know is on the table and the potential implications?
Yeah, so what's on the table is for any existing properties that are owned, they will be grandfathered, and the negative gearing will be able to apply. And look, there's a practical measure to that. If someone's recently bought a property and done their numbers around the cash flow and negative gearing, it would be very harsh for the government to force such a significant impact on household cash flow, given the majority of investors in residential property are in that sort of, that middle class Australia. So it will be grandfathered, and going forward, negative gearing won't be allowed on existing properties, but it will be allowed on new builds. Now, that brings a very interesting insight into what investors may be thinking. If it's like a property that's subject to pre-1985 rules in CGT, you tend not to sell it. And if you've got a property that has the benefit of negative gearing locked in, you're probably never going to want to pay down that debt if possible, and you're going to want to hold on to that property. So you probably will see a cohort of investors not willing to sell, so you're not going to see a lot of supply onto the market. But equally, you'll probably see a lot of investors that would have run the numbers on a negatively geared property now thinking twice, because they're not going to get that tax break.
Yeah, all right. So that begs the question: is what does this actually help solve the problem of undersupply in terms of the housing market, and particularly, I guess, if there are that cohort that's going to hold on, but also, and I was reading a headline this morning that might be properties bought post Tuesday night, but it wouldn't come into effect until next year. What do you think it would do to supply?
Look, the incentive obviously is to keep negative gearing on new builds, and so it's encouraging investment in new builds. So I think that is an important measure that the government needs to target. Where I think it is let down is what the government should be focusing on is productive investment, and it's a shame that this, the capital gains tax changes are affecting every asset. But on the negatively geared aspect of it, I think it does make a lot of sense for government to be allowing those concessions for newly built properties, rather than subsidising investment in existing stock. So in terms of purchases from tonight or tomorrow night, it's touted that there'll be no negative gearing on purchases of existing properties.
And just finally, let's take a look at trusts. I mean, family trust, that's a popular vehicle that employed here in Australia. What do we know how that's likely to be treated?
Yeah, this is another rehash of 2019 in terms of the tax changes that were proposed by the Labor government. It's putting a floor of 30% on trust distributions. Now, Essentially what that means, distributions from trusts currently to low tax beneficiaries where there's not a lot of existing income, they do get the benefit of marginal tax rates. Essentially what it's saying, if you're distributing to someone with income below 45,000, well, they will be paying 30% tax on that trust distribution regardless. So really, it's not going to be any different if the distribution is going to someone on income above 45,000. What is unknown, of course, is exemptions. What we know from 2019 is deceased estates, so testamentary trusts were exempt. There were exemptions around farm trusts, unit trusts. So it will be very interesting to see the detail of the legislation. And what it didn't really solve is putting distributions to corporate beneficiaries and those structures in corporate beneficiaries through share classes still allowing the distribution of franked dividends to lower tax beneficiaries.
So, Rob, come Wednesday morning when we're digesting the budget, what should investors do?
Well, like anything, there's always transitional arrangements. It's speculation now. We will get more clarity tomorrow night. And I think it does sort of require everyone to think about decisions that were on the table and how those decisions will now fit into the new tax regime. I think it does make superannuation certainly look very attractive on a number of fronts when you're looking at capital gains tax and negative gearing side of things.